Now, there's great concern about the fiscal deficit. That concern, however, is lessened by good news from international trade. Here to explain and put some context on that is Tom Keene, Bloomberg's editor-at-large. Explain, please.
This is a wow statistic. This was not only an improved current account deficit, a little bit off the survey, but it was better yesterday. But the revision, even with the changes there, it is absolutely remarkable, the ground that we've covered.
And I'm looking at the numbers here just to refresh
Sure.
for our viewers. The current account balance for the first quarter coming in at $101.5 billion.
Yeah.
That did not narrow as much as expected.
It didn't narrow as much as expected, but Scarlett, this is a big deal. When you compare it to our nominal GDP, which is what you do, when you look at the trade flows and the capital flows, this was good news for everyone in America. This has come back fast and furious as a percent of GDP.
And what's driven that?
What's driven it is the dynamics of exports and imports and a little bit capital flows. Derek Halpenny at Bank of Tokyo, Mitsubishi in London makes very clear it's not just about trades of goods and services. It's about improved investment flows and capital flows as well. And when you see all this, when you see, yes, less exports to the beleaguered world,
Sure.
and also our lower imports, the answer is a very good, very good statistic that we've seen.
Okay, you also have put together a chart.
Yeah,
We
I
saw
got
it
a chart
briefly.
here.
Let's talk through it.
Let's bring that chart up, and you can see here the current account deficit back 30 years. You can see the little bit of a surplus there in the middle of the chart. Down we go, and you can see that spike up on the right side back to 1999. We've gone from 6.6% of GDP as a deficit to 2.9%. So this is one of those things pushing back against the legitimate concern about our own domestic fiscal deficit.
Okay, it's come back very quickly. Couldn't you say that it could go back down very quickly as well?
Absolutely. There's no question about it. If you see a return to the kind of buoyancy we had in the past 5 years, it could turn right around and go back down. In fact, many economists are expecting that. In the short term, say 1 year out, Halpenny at Bank of Tokyo is looking for a continued improvement with that stronger dollar versus the euro.
Now, you're talking about investment inflows as well. The U.S. has certainly benefited from this flight to safety that we've seen at the end of last year. And as we mentioned, it could turn around very quickly because we've got the risk trade in full swing, at least through the first part of the second quarter.
And what this comes down to is first order, second order, and third order effects. One of the biggest problems we have in the media is lining up what matters the most. Obviously, trade balance matters a lot, but a critical thing here, Scarlett, is yes, we're worried about the Chinese. Will they buy dollars? Will they continue, rather, to buy our paper? And we saw that reaffirmation by S&P yesterday on the AAA rating of the United States. But when everything is said and done and you look at the ebbs and the flows, this is unambiguous good news. No one I read or speak to expected such a rapid recovery in the current account deficit.
Okay, so
it was secondary news yesterday, but very important.
So the takeaway here, good news on current account deficit. You also are looking at a couple of things for the surveillance program.
Well, yeah, we're back in New York today, Ken Pruitt and I, and it's Father's Day, so we've got Robert and Sam Stovall. It's an annual show we do, and we're going to get the dueling Stovalls in to talk equity markets.
The dueling Stovalls. Looking forward to it.
Stovalls.
Bloomberg Surveillance starting at 7 a.m. Eastern, running through 10 a.m. Eastern right here on Bloomberg Radio.